Fed Chair Jerome Powell raised the possibility of bigger interest rate hikes as the central bank looks to tackle stubborn inflation. His hawkish comments were made at a hearing on Capitol Hill yesterday.
Inflationary pressures are running higher than expected at the time of our previous FOMC meeting. The latest economic data have come in stronger than expected, which suggests that the ultimate level of interest rates is likely to be higher than previously anticipated. If the totality of the data were to indicate that faster tightening is warranted, we'd be prepared to increase the pace of rate hikes. Congress really needs to raise the debt ceiling. That's the only way out.
You're raising interest rates to slow the economy, are you not?
Yes, to cool the economy off.
So in effect, I'm not being critical. When you're slowing the economy, you're trying to put people out of work. That's your job, is it not?
Not really. We're trying to restore price stability. I think nothing about the data suggests to me that we've tightened too much. Indeed, it suggests that we still have work to do.
How would you explain your view that they need to lose their jobs?
I would explain to people more broadly that inflation is extremely high and it's hurting the working people of this country badly. We are taking the only measures we have to bring inflation down.
And putting 2 million people out of work is just part of the cost, and they just have to bear it?
Will working people be better off if we just walk away from our jobs and inflation remains 5-6%?
Well, that gives you a little summary. Set to music with what we heard from Powell. That was before the Senate Banking Committee, as you saw Senator Elizabeth Warren there questioning Powell. He's heading back to Capitol Hill today for the second round of hearings before the House Financial Services Committee. And Ines, in the wake of his comments yesterday, we've seen a number of banks raise their rate estimates, not necessarily for the meetings incrementally, but the terminal rate, as it's called, the place where the Fed is going to end up.
Yeah, and one of them being Goldman Sachs, basically saying that Powell's testimony is pointing to higher terminal rate, and that opens the door to faster hiking pace. So Goldman Sachs raising its terminal rate forecast to 5.5 to 5.75%. The Fed policy rate right now is currently at 4.5 to 4.75, and it's 7.5%, that range. But certainly it's significant that Goldman has increased its forecast for the terminal rate. It's significant that banks are sort of forecasting like, well, could the Fed increase rates by 50 basis points at the next meeting? We had thought it would be 25 basis points. There's a debate going on whether or not it will be 50, it will be 25. Citi is actually fading the 50 basis point hike narrative, saying that we like to fade the 50 basis point hike narrative. As in our view, it would essentially mean that the Fed is giving up on a soft landing. And that goes in part with what Jerome Powell was saying yesterday as well, when he was really being pressed about the unemployment. So unemployment has to go up. So people have to lose their jobs. You're saying 2 million people have to lose their jobs. So by them raising by 50 basis points, are they giving up on that soft landing narrative?
Yeah, and then he, of course, pushed back against that and saying, well, these people are losing their jobs, but what's better for them to be continuing to pay ever higher rates of inflation, right? So it's obviously a dilemma. One other quick note here as we talk about rates going higher for longer and the expectations for a hard or soft landing is that we now have yield curve steeper in inversion, or deeper in inversion, I should say. That means the yield on the 10-year minus the yield on the 2-year as an indicator of recession. We're going to talk more about this later in the show, but it is something that economists and strategists are watching very closely.